Are you interested in buying a home, but that overwhelming thought of saving up for that huge down payment is holding you back? I'm Stephen Burns, and I help home buyers like you get a mortgage without struggling with the overwhelming process of achieving home ownership. In today's video, we're going to discuss all the ins and the outs of down payment. We'll go over some of the main questions. How much do you need for down payment? Other costs involved, different programs, where to get your down payment, source of funds, down payment assistance, and finally, how much should you put down for down payment? All right, let's start off with how much do you need for a down payment? The common assumption that most first-time homebuyers make is that you need 20% down payment. In reality, the minimum down payment is actually zero. Yeah, that's right, zero. The most common for most first-time homebuyers, though, is either 3% down or 3.5% down. However, if you're going to be putting less than 20% down, you will be paying mortgage insurance, also known as PMI. More down usually means better terms. All right, so closing costs. That is beyond the down payment. Those are other additional costs. One of the big ones is your first installments of taxes and homeowners insurance. Then there are title and escrow fees. Then the big one, which pertains directly to your loan, is the origination fees. These are sometimes listed as origination fee, underwriting fee, processing fee, administration fee, and also discount points. So those are the big ones you really want to look at. That'll be on box A of your loan estimate. Not all lenders or programs charge these fees. Of course, the appraisal fee, if you don't get a waiver, credit report fee, inspection fees, such as home inspection, termite, septic, well, all kinds of different home inspection fees that could be out there. The ones you just can't get away from is the government recording fees. Then there's prepaid interest. Depending on the time of the month that you close, you may have more or less prepaid interest. The earlier you close in the month, the more prepaid interest you have. Close at the end of the month, the less prepaid interest you have. However, you're going to pay this interest pretty much anyway, so it's 6 to 1, half dozen to the other. Let's talk about different programs. Let's start with the no down payment options. The first, and in my opinion, the best loan out there is a VA loan. So a VA loan is for veterans or their surviving spouses only. What's great about a VA loan is there's zero down payment and there's no PMI. Then there is a USDA loan, which is also known as a rural development loan. And like it says in the name, it's for rural areas. So there are some serious limitations on this loan. So you're gonna have to do some research and see if this loan is going to be right for you. The limitations on this program are mainly based on location. As it says, it's in a rural area. There's income limits. Income is based off of your household income, not just your individual qualifying income. And there are also loan limits. So depending on the areas you're looking to buy, if those areas are a little bit more expensive, then you're really not going to be able to get a loan in that area for zero down. Then there's also strict debt to income ratio requirements on USDA loans. So you don't get to push the limits as much as you would on a VA. Next is FHA. FHA seems to be one of the most popular loans out there for first-time homebuyers. One of the biggest benefits of FHA loans is they have low rates. And even if you don't have great credit, they still have great rates. Another thing about FHA is the mortgage insurance is based on a fixed rate. It's not tied to your credit scores. So if you don't have the best credit, this is actually a really good thing because the credit scores don't hurt your mortgage insurance rate. However, if you have great credit, then FHA might be something to look at compared to maybe a 3% down conventional program. Another great thing about FHA, same as USDA or VA, is you can actually use lender credit to cover your closing costs. So we'll just use some examples. At the time of filming this video, if you had great credit on one of these programs, then a par rate would probably be somewhere in the low 2s. However, if you wanted us to cover all your closing costs, maybe you'll have an interest rate around 3%, and all you have to do is come up with the down payment alone. You don't have to pay all the extra closing costs that we talked about earlier out of pocket. Now, another thing about FHA is the loan limits. The loan limits are lower than most areas conforming loan limits on a conventional loan. So again, if you live in a higher cost area or looking in a higher cost neighborhood, then these loan limits might hold you back from being able to qualify for something using only the 3.5% down payment. If you're looking to buy a condo while also using FHA, then you may be a little bit limited on the condos that you can look at. FHA requires the condominium complex to be approved on their FHA roster. There is a public website that you can go on and get this information. But just keep in mind that you may be limited on the amount of condos you can look at because it is a very limited list. And on FHA, if you're putting less than 10% down, then the mortgage insurance stays on for the life of the loan. It never falls off like it would on conventional. All right, then there is the 3% down conventional program. Yeah, you heard that. 3% down is all you need for a conventional program as long as you meet the requirements. And the first of those options is you have to be a first-time homebuyer, or at least one of the occupying borrowers must be a first-time homebuyer. Then there is the Fannie Mae or Freddie Mac Home Ready or Home Possible options. And those are based on income limits. So you have to look at the maps, look at your area median income for those neighborhoods, those housing tracts, and make sure that you meet those requirements. Usually it's 80% of that area median income. What's great about the Home Ready and Home Possible programs is they usually have better interest rates and better mortgage insurance rates. One of the great things about conventional is they usually have a higher loan limit compared to FHA or USDA loans, which means that you could buy a higher purchase price while still only putting 3% down. All right, so the thing with conventional is credit scores are a huge factor in determining your interest rate and your mortgage insurance rate. So if you have low credit scores, then your rate and your mortgage insurance is going to be quite high, especially if you're putting a low down payment. Where if you have great credit, then a 3% down conventional could be a great option because you still get great rates and your mortgage insurance could be quite a bit lower than on an FHA. Another thing that's great about conventional is they are less strict when it comes to condominiums, and they're less strict when it comes to the condition of the property. Whereas FHA, USDA, and VA are more strict when it comes to the conditions of the property. With conventional, there's really little to no room for us as lenders to offer lender credit by increasing the interest rate. So there could be a little bit, but it's very marginal and it's usually not worthwhile. One of the biggest benefits of conventional is that the mortgage insurance can eventually fall off. And there's a few different ways that it can fall off. It can fall off naturally over the amortization of the loan once it reaches the 78% loan to value mark, or if your loan has been paid down faster than the traditional amortization schedule, then you can actually have your mortgage insurance falling off quicker. And one of the other options with dropping mortgage insurance is if your home appreciates rapidly, whether that is because the market has increased very quickly or you've done some major repairs and improvements to the property and your value has gone up significantly, you can actually request an appraisal and have your mortgage insurance dropped early. All right, now let's talk about 5% to less than 20% down conventional options. More down payment usually means better interest rates and better mortgage insurance rates, especially the mortgage insurance. Mortgage insurance is based off you putting less than 20% down. So if you're putting 3% down, that means a much larger portion or percentage that needs to be insured. Whereas if you put 15% down, that's a very small percentage that needs to be insured, which means that your mortgage insurance rates are going to be significantly lower. Anytime you put more than 5% down, there is no income limits, which is great if you are a high income earner. As with all conventional, rates and mortgage insurance is going to be heavily driven by your FICO scores. So if you have a low FICO score and you're putting low down payment, your mortgage insurance is going to be quite high. Whereas if you have great credit scores, then you don't necessarily need to put a big down payment in order to have good mortgage insurance rates. And with conventional loans, there really isn't much room for us as the lender to increase the interest rate and give you lender credit. There might be some marginal ability to do so, but usually it's not worth it. And the more you put down, the faster that your mortgage insurance will drop off. All right, now let's talk 20% or more down. And the big one, no PMI. I know that's a big one for a lot of people. And with no PMI, that means less restrictions. There's no mortgage insurance overlays. And the more you put down, the less risk the lender has to deal with, which means the lower your FICO scores can be. And usually, as I was saying before, the more down payment, the better your terms are going to be. Usually once you get past 40% down payment, you're in the lowest risk threshold, which means you're going to qualify for the best interest rates. So there is no first-time homebuyer requirements or income limits for 5+% down conventional. So where can you get your down payment from? You got to remember, all funds need to be sourced and documented. That means if you have a big old wad of cash that you had stored underneath your mattress, can't just use that. All right, some sources. So of course, you can use your bank account. That includes your checkings, your savings, CD, money market, so on and so forth. Then there's investment accounts, such as a brokerage account, including stocks, bonds, ETFs, etc. And then there's retirement accounts. Depending on your plan, some plans will allow you to do an either early withdrawal or borrow against your retirement. And there's a few different ways you can use the money from your retirement account towards a down payment. Number one is a hard withdrawal. Now keep in mind that if you're under the age of retirement for your plan, then you will be subject to a 10% penalty for early withdrawal, and you'll be subject to income tax based on the amount that you pulled from. Another great option, depending on your plan, is you could do a loan. You could borrow from your retirement account. Usually you have to pay that back with interest, but that interest is going back to your retirement account. And the reason for that interest is so that way it catches you back up from the funds that you pulled from. Now remember, not all plans allow these options. So make sure you contact your plan provider and see if these options are available And I do recommend getting in touch with your provider early on, so that way you know what options you have available and start strategizing with what you can do. And of course, crypto. You can use crypto as long as you document it properly. You could sell real estate that you already own, and you could use those funds to buy more real estate. You can get a gift. Depending on the type of program that you're using, it may need to come from a relative or a close family friend that you can document and prove that you have a close relationship with. All right, so cash. While yes, you can use cash, as long as you document it properly. And usually you need to have your funds seasoned in your bank account for at least 2 months, or it's one of those other options that we have to document. So if you have cash, plan ahead, and if you can, put it into your account, let it season for a few months, and then we can use it. All right, so down payment assistance programs. What are they? So down payment assistance programs come in many forms. The most popular usually is a second or a third loan. Usually your second loan is going to cover your down payment. Your third loan is going to cover a portion of your closing costs. Then there are grants. That means that you don't have to pay these back. And then sometimes there's loans that actually get forgiven after a certain time period or if you meet certain criteria. On most down payment assistance programs that I've seen, the borrower still needs to come in with funds towards their closing costs. Usually it doesn't cover all of their closing costs. And another thing with down payment assistance programs is the interest rates and the closing costs are usually higher. So yes, they might help you cover some closing costs, but they're probably only going to be covering a portion of it. So you may still need to come in with maybe 1.5%, maybe even 2% of the purchase price in your closing costs. So with most down payment assistance programs, you're still going to need some money available towards some closing costs. All right, so what's the catch with these? Well, free money ain't free. So the thing with down payment assistance programs is usually they have more fees, which means there's more cost involved. Usually there's a higher rate. Sometimes you're going to be getting second or third loans, and sometimes those loans may or may not accrue interest over time, and some of them may or may not require monthly payments back on those loans. And they're usually stricter, which means that the credit score requirements are stricter, there's income limits, and the debt to income limits are usually stricter as well. So there's a lot of different nuances about these. You definitely want to talk to your loan officer, see if it's the best program for you. Now, are they worth it? Well, it really depends. Everyone's situation is unique. Usually my thoughts are, if you can come up with a down payment, usually you're going to get overall much better financing terms. However, if this is the only option you have available, then yeah, by all means, do what you can to get your foot in the door into a home, start building that equity, and start paying your own mortgage rather than someone else's. Now, with this being said, how much should you put down? Well, that's really going to depend on your situation. First, how much do you have available? Just because you have a large sum of money doesn't mean you want to use it. Maybe you have a business that you run and you need to keep money available. Maybe you have an investment that you plan on making that you need to keep these funds available. So maybe you have all these funds available, but you need to ask yourself, how much are you comfortable using? And some things to keep in mind. Do you have emergency reserves? Do you need to put money into the home? Maybe this home you're buying needs a new roof, or maybe you plan on putting a pool, or maybe you need to fix that driveway or put in a new driveway. Well, you need to make sure that you have these funds available. So you don't want to go liquidating all your cash and not have money to do the repairs that you plan on doing. Do you have any high interest debt, such as high interest credit cards or high interest personal or auto loans? Could you take that money and put it towards those to free up some monthly cash flow? Really depends on your situation. More isn't always better. Is that money better served somewhere else? What do you think? Which down payment option do you think is best for you? Let me know down in the comments.